Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's 8:05 a.m. Boston time. You're all going to receive first housekeeping notes. You're all going to receive the full um, audio summary this week, partially due to travel schedules. We wrote a very dense, extensive note this week. If anyone would like to see the full note, by all means, let me know, and I'm happy to send it along to you, even if you're not a full subscriber, or better yet, ask for a 1 month trial. We're more than happy to offer one to see if you'd like to become a full subscriber. So the note this week was titled Under Promising, an old Wall Street saying, under promise and over deliver. In this case, we suspect the Fed originally, we thought they were going to underpromise and underdeliver. Now it appears through the course of the weekend that they may very well overdeliver, provide a 50 basis point rate cut to start the process. But the summary of economic projections is likely to underpromise relative to where the markets are at this point, which is essentially a policy rate below 3% at the end of 2025, which is part of an argument we've been making for several weeks now that earnings expectations of 13% according to Bloomberg, 15% according to Lipper Refinitiv for 2025, combined with a policy rate that falls all the way to 3%, seems a highly improbable outcome. So this week's note had 5 sections to it. The first section we titled Costanza Banking Rules. The financial market pundits seemed somewhat curious why Vice Chair for Supervision's Barr's reproposal of bank capital requirements, dropping that total requirement for the largest banks from close to 20% all the way down to 9%, was receiving such a negative market reaction. And we explained in the note that any increase in bank capital requirements would be a monstrous mistake. The banks are already overcapitalized and are being nudged out of important businesses by areas like private credit, private equity, independent traders like Citadel, for example, have pushed the street out, and any additional capital requirements would be a mistake. We then go on to talk about or review last week's inflation data. We described that as turbocharged pre-pandemic inflation trends. We then offered a preview of this week's Fed meeting, which will of course be the meeting of the week, and that's our under promising and under delivering section. We then had an extensive discussion of potential policy changes, and we titled that section Debating Taxes, Spending, Deficits, and Debts. And that was a little bit of a nudge to ABC's debate the prior week, where there was not one question about taxes, spending, debt, and deficits. There was some discussion of tariffs, which was a little bit of a taxes discussion, we suppose, but they really missed on the big issues. And then we finished up with our market summary, which we called Party Like It's 1995, as a nudge towards the big tech-led rally we had last week. So first on the Costanza Banking Rules, Vice Chair for Supervision Barr gave a speech last week and talked about the essentially reproposal, although almost immediately Michelle Bowman, who's been battling Barr at the Fed about this, came out and said, no, you need a full reproposal. She's obviously not on board with any increase in capital requirements. And so that issue remains undone, but they are trying to push this through before the presidential election in November. The quiet period, or the comment period, excuse me, ends shortly after. And again, we just think it would be a big mistake. We then went on to really review the inflation numbers last week, and we've been long arguing that through the O's and the 10s, that the vast majority of the undershoot in inflation and the Fed's 2% inflation target that they adopted back in 2012, I believe it was was attributable to an exogenous force, which was China and the emerging world's integration into global supply chains that essentially created zero goods inflation for a period of nearly 20 years. And that domestically determined housing inflation ran at 3%, super core services or non-housing services ran at 2.5 to 2.75%. So in the stuff where the Fed had some degree of control, or could contribute to the inflationary forces, they were actually overshooting their target through that entire period. Consequently, the excessively easy policy misallocated capital. It channeled a lot of money into financial operations, stock buybacks, and the like, rather than letting the market decide, and was in essence a big mistake. Well, those trends are now really on offer. In the report, you can see that goods price deflation is running at 1.6%. That is a second wave of deflation coming out of China as they try and export their way out of their housing crash. And we added a pretty good chart on house prices that came out late on Friday night, probably late, so late that most of you didn't notice it. It was 9:30 Eastern. Anyway, that global force has created most of the disinflation that's occurred at this point. House prices actually picked up in the latest month, and housing-related inflation is running at 5.25%. Services inflation is running well into the threes, but the aggregate level is 2.5%, subject to about a 30 basis point annualized standard deviation. Both of those are below the long-term, longer run medians going all the way back to 1947. So at this point, it's unlikely that goods force is going to change very much, and the risks are all on the labor market side. So we then reviewed a little bit where that services inflation is coming from. It's fiscal policy, and the Fed can't resolve that problem all on their own, just as they couldn't in the 60s and 70s. And so they ought not to try. They need to get the government involved, and we'll come back to that discussion in a minute. And then as far as housing goes, we think they exacerbated the core housing shortage in this country through passive QT and aggressive rate hikes, which deeply inverted the curve and cut off credit and raised the cost considerably to small mom and pop builders. The big publicly traded builders have been thriving in this environment because they can sell longer term debt. And that's a core theme we've talked about a lot, and it is integrated in the note about how if you can finance out on the longer end of the curve because credit spreads are tight, again, due to the Fed's portfolio balance channel effect of holding all those treasuries and mortgage-backed securities, and the negative term premium associated with those holdings of treasuries, if you finance out the curve, financing rates are incredibly attractive. If you finance at a floating rate, you're a small business, small builder being probably the most extreme example, you're really struggling. And that's has impaired the supply of housing and is making the housing situation worse. So the way the Fed conducted the tightening process, we think was a massive policy mistake. And it is showing up in housing. And so the way to fix that is counterintuitively to actually disinvert the curve by cutting the policy rate down to 4% and easing the housing supply story. So in this case, we actually think rate cuts will not exacerbate housing-related inflation. It'll probably loosen supply. So moving on to the Fed meeting this week. As we got to the end of last week, it was becoming clear that there's a number of advocates who were FOMC participants. Bill Dudley, who's got another column out this morning, Don Cohn, Loretta Mester, Esther George, and one that we missed in our note, but was pointed out to us over the course of the weekend, Rob Kaplan, are all calling for the Fed to kick off with a 50. There was no pushback, no Nick Timiraos Wall Street Journal story this weekend. In fact, the only Wall Street Journal story came from the former Fed whisperer, Greg Ip, whose columns we like a lot, advocating for a 50. So it looks like they will probably over deliver here a little bit and give us a 50 basis point cut. But then the summary of economic projections is going to be likely a bit disappointing for the markets. And so, middle of last week, we were thinking they were going to underpromise and underdeliver. Now they may overdeliver, but underpromise nonetheless. in order to get the kind of data that would get the policy rate to 3%, we're going to need weaker data, and that's not really consistent with the kind of earnings acceleration the market's expecting beyond the third quarter. Third quarter numbers are fairly tepid, but then they are expected to pick right up in the fourth quarter and run strong throughout the course of next year. And we think that's likely, and we think the market is vulnerable to weak consumption data. We get retail sales tomorrow, vulnerable to weak housing data, which we could get more of beginning this week and into next, and then certainly vulnerable to additional weakness in the labor market as we expect. So one final point on all this, the 3-month, 2-year curve has never been this deeply inverted going into a cutting cycle in 40 years. And that just underscores the point that it's going to be hard for the Fed to deliver on market expectations. Yes, we know that the Fed got away with that earlier in the year, but we think this is a very different situation because the data is likely to weaken further, unlike early in the year when the data actually strengthened. So moving on to taxes, spending, deficits, and debt. We did have an extensive discussion of the tariff situation. We had some pretty good references in there. We would suggest you read that section. In so many ways, we thought that the trade war that we're now engaged in and will likely intensify was inevitable. Very similar to prior periods, there's this idea that we've had this golden era of free trade. It's not really the case. In 1971, we went off the gold standard because we started running trade deficits for the first time since World War II. Reagan had 100% tariffs on semiconductors back in the mid 80s. We've had a low-level trade war going for our entire history. In some cases, it's been a high-level trade war, and we think it's likely to intensify. As far as tariffs being taxes and being paid by the American consumer, certainly anything that creates a barrier to economic efficiency had to be considered in some first-order sense inflationary, but then ultimately we think this will be more deflationary than inflationary because of the weak condition that two of the biggest exporters in the world and biggest economies of the world, China and Germany, find themselves in. So additional trade barriers are only likely to exacerbate the troubles of both of those nations. And in fact, this will probably be more deflationary. Also, one other additional point on that is that when former President Trump put a 10% tariff on Chinese imports back in 2018, maybe 2019, we had an immediate 10% adjustment in the exchange rate. So it's not so clear how that price will actually change all that much. But really the bigger issues here that we delved into were taxes and the idea that regardless of how we've organized our tax structure over the last period since World War II, we've collected a little less than 18% of GDP in taxes. So in many ways, it's exogenous to economic activity. You can change the degree of progressivity, but you still get 18% in taxes. So there is no doubt that we have a very negative skew in terms of potential presidential outcomes for the equity market, where the Dems to sweep, the antithesis of the situation in 2016, and we were to get higher corporate tax rates, higher capital gains rates, and even try to tax unrealized capital gains. That would be a big negative for the equity market, and not just a one-off shock. It would lower the degree of capital formation over time. So it's a fairly improbable outcome, but nonetheless, the skew is negative, and the market should probably reflect that risk to some extent. On the spending side, there is again a long history of the government spending roughly 20% of GDP since World War II. That's where we were at in 2017, 18, and 19. During 2020 and 2021, the government spent 30% of GDP in taxes, the biggest surge we've ever seen through the pandemic. That's on both the Trump administration and the Biden administration. But we've settled in 22, 23, and 24 to 24% of spending as a percent of GDP. And that's a level where you just can't close the gap. The first order effect of that is inflation. We've pointed that out in terms of government wages running at 100 basis points faster than private sector wages, government employment growth running at about 140 basis points above private sector growth. Again, the first order effect of all that is inflation. We don't worry as much about a debt crisis, in part because GDP is a flow variable, debt is a stock variable. You really should be thinking of the amount of debt in terms of the total household net worth in this country. And on that metric, it's not quite as, the aggregate level of debt isn't quite as scary, notwithstanding we suppose, making a little bit of a, it's different this time argument because, once debt has gone above 100% of GDP, it's tended to keep just right on going. But the real issue is servicing that debt and that spending at 24% of GDP and the first order effect being inflation rather than a debt crisis. We're not saying one couldn't happen, but the real issue again is the inflationary impact of all that spending. So neither candidate has really offered any serious suggestions about cutting spending, but that is going to be an issue in 2025 to be sure. So wrapping the note up this week, we really got into this idea that we could just have again, a resumption of the tech-driven rally that occurred through the first 7 months of this year. Were that labor market data to stabilize, for example, we think that would be the trend. That would prevent the Fed from cutting aggressively after the 50 basis point cut it seems we're likely to get this week. And then that would leave small banks and small businesses in the same position that they've been in for the last 18 months or so, which is with a deeply inverted curve, 5% return on equity on the regional bank index, putting them in no position to extend credit to small real estate builders or small businesses generally. So more likely we are going to get weak data. The Fed will cut towards 4% by the end of the first quarter, into the first quarter. That will relieve some pressure over time. Again, though, we're concerned that on the way, banks may tighten credit because of concerns about the ability to pay. So just getting a smooth path to 4% to us still seems like a fairly low probability outcome. For that reason, we continue to hold a decent allocation of cash. The tech sector, though, is in a super cycle trend, and we agree with our friend Dan Ives that it's likely to persist. We also think that although energy's come under a lot of pressure recently because of concerns about China, because of concerns about slowing growth in the US, that the power required to run all those new data centers that Larry Ellison from Oracle's promising us is going to increase demand. And the supply story for us for energy is really about more elasticity of supply that's in part of the shale story. And it just creates a higher and more stable ROIC for these companies over time. So we know energy is unlikely to rally anytime soon, but the group is inexpensive with what we think is likely to be higher returns and more stable returns. And we think demand will pick up over time as well. So those are the two sectors we really spoke about at the end of the note. And that's what we'd like you to think about. As far as putting that 20+% cash we have in our equity suggested portfolio, again, we would wait for a downtrend, which we think is reasonably probable. We doubt it's going to be a smooth path, in part because the Fed is likely to underpromise. So that's it for me this week. Again, if you'd like to get a trial subscription, please consider doing so. We're happy to do that for you. Thank you. Have a good week, everyone.